Right now, the most dangerous thing you can do with your portfolio is assume the market will keep going up forever. Over the last few years, a massive wave of euphoria has swept across Wall Street, driven by a single phrase: artificial intelligence. But look beneath the surface of the S&P 500, and a terrifying pattern is starting to emerge. Are we on the verge of a historic market correction, or is this volatility just the final buying opportunity before the next leg up?
Welcome to my channel. Let's jump into our today's video.
To understand where the stock market is heading next, we have to look at what's actually holding it up. If you own a standard S&P 500 index fund, you might think you are diversified across the top 500 companies in America. But you're not. We are currently experiencing the highest level of market concentration in modern history. A tiny handful of mega-cap tech giants, Nvidia, Microsoft, Apple, Alphabet, and Amazon, now account for nearly 30% of the entire index's total weight. When these 5 companies go up, the whole market looks healthy. But over the last few weeks, institutional investors, the big banks and hedge funds, have quietly begun pulling billions of dollars out of these exact stocks. Wall Street calls this rotation. They are taking their massive profits from the AI boom and hiding cash in defensive sectors like consumer staples, energy, and healthcare. When the smart money starts moving to the sidelines, retail investors need to pay close attention. But why are they rotating now? The answer lies inside the Federal Reserve. For months, the market has been betting on aggressive interest rate cuts to keep the economy pumping. But inflation in the U.S. has proven to be incredibly stubborn. The Fed has made its stance clear. They will not risk lowering rates too early and sparking a secondary inflation wave. For stock valuations, this is worst-case scenario territory. High interest rates act like gravity on stock prices. When borrowing money is expensive, it crushes the future earnings growth of highly valued tech companies. Right now, many of these AI-adjacent companies are trading at price-to-earnings multiples that assume absolutely flawless execution for the next decade. If growth slows down by even 1 or 2%, the valuation compression will be brutal. We already saw hints of this during the recent earnings season, where companies reported record profits, yet their stocks collapsed because their future guidance wasn't perfect. So, what is the actionable move for everyday investors watching this unfold? First, don't panic sell, but don't blindly buy the dip on overhyped tech stocks either. The era of easy money, where picking any random AI stock guaranteed a 30% return, is officially over. Smart money is shifting toward value. Look for companies with strong balance sheets, actual free cash flow, and low debt. Businesses that thrive regardless of what the Federal Reserve decides to do with interest rates. Diversification isn't dead. It was just ignored during the tech rally. Rebalancing into broader equal-weight index funds or dividend-paying equities can insulate your portfolio from a sudden tech sector shock while keeping you positioned for long-term U.S. economic growth. The U.S. stock market is entering a critical transition phase, and the decisions you make with your capital over the next few months will define your returns for the rest of the decade. I want to hear from you. Are you buying this tech dip, or are you moving your money into cash and safer assets? Drop your strategy in the comments below. Make sure to hit that subscribe button and turn on notifications so you never miss a critical market update. Thanks for watching, and I'll see you in the next video.